Hey everybody, what is up? Welcome back to Final Trade. I got a question from a patron and I decided to make a video out of it because this is a question that I literally get about once a month from various patrons, and it has to do with how you account inventory in this type of business. And I'll go ahead and read the question, and then I'll kind of explain it a little more, and I'll go into my answer and my reasoning. He says, part of what I'm doing is buying collections. It's near impossible to itemize out all of it, considering that some of the collections are in the 5-figure range. One was exceeding $50,000 at a 60% buy list rate. Other people have told me those are considered inventory when the first part sells, but I'm not sure if that's correct. And so what I realized from talking with him a little more is that it appears that he's using cash accounting and not accrual accounting. And so the difference in that is cash accounting says that you record revenues and expenses as cash changes hands. And so let's imagine this business, the very one that all of us here have, and you buy a whole bunch of collector boxes that you mean to hold for long term. Well, cash accounting says that when you pay for those boxes, you can expense those as essentially a cost of goods sold in your business because you spent money for them. And so let's say that, at the end of this year, you go out with $100,000 of cash and you buy collector boxes. And prior to that, you only had $10,000 of profit in your business for the year. Well, now you're going to show a $90,000 loss, even though most of that delta that happened there, that $100,000 delta from buying those boxes, that's still inventory sitting in your closet. You really didn't lose the money. You spent it on inventory to sell in the future. And so you would get a $90,000 deduction against the rest of your taxes, and you'd probably have to carry that forward into the future. And yeah. So accrual accounting says, well, we're going to keep track of what you buy, but you don't get to recognize the cost of goods sold until you actually make the sale. And so you would go out today with that $100,000 and you would buy those collector boxes and they would go onto your balance sheet as inventory, but you would not recognize that as a business expense until piecemeal in the future you are selling those boxes. And so let's say in 2025, you sold $50,000 of those boxes. Well, you would recognize that $50,000 as cost of goods sold, and you would still carry the other half of it on your balance sheet into 2026. And let's say in that year, you sold $30,000 of the boxes. Now, it doesn't matter what you're selling them for in the future. We're talking about your recognized expenses and your costs of goods sold. And so that's the difference between cash accounting and accrual accounting. And generally, the IRS wants you to use accrual accounting in this kind of business, any kind of business where you carry a lot of inventory and you carry it for a long time. They want you to use accrual accounting. And the reason is they don't want you doing exactly what I just described, which was going out there and dropping $100,000 cash in order to get a $100,000 essentially deduction from the IRS. And so they're going to have to pay you for that, because you're through your Schedule C, your business income flows through to your personal 1040. And so they're going to have to then pay you a bunch of money subject to other limits, okay, and carry forwards and all that other good stuff. So they don't want to do that. And then in the future, when you eventually sell that inventory years down the line, you have, for tax purposes, a basis cost of zero at that point, and you'll pay taxes on the full sales price in the future. They don't really want that because it means they have to pay you a lot now and you're going to pay them back more later. What they really want is for less money to change hands at a time, instead of a big change here where they pay you for this huge deduction because you had $100,000 of inventory expense, and then later on, you sell those boxes for $200,000 and you have to pay taxes on the whole thing. They don't really like that for businesses that carry a lot of inventory. And you can think of other types of businesses where cash accounting would be very appropriate, like potentially a casino. What inventory does a casino carry? It carries cigarettes and alcohol. That's it. That's the inventory in a casino. And so what are their cash flows from? Well, they take in cash and they hand out chips. And so that transaction, that is a revenue for them. And then at the end of the night, they hand out cash to take back chips. And that's an expense for them. And so they would probably record that through cash accounting immediately. And, they're probably not going to keep a ton of cigarettes and alcohol on the books. And they probably cycle through it fairly quickly. They don't hold it for a long time. They're not trying to let that tobacco age or anything. So, cash accounting may make sense for a casino, right? So here where we're having lots of inventory, accrual accounting is the more correct method. Now, when it comes to things like buying big collections, how do you accrual account those? So you can take that collection and you can break it down into individual cards. The most pedantic and soul-crushing way to do it would to break it down on some kind of inventory database and say, well, it was 100,000 cards and I paid $100,000. So now I have 100,000 units of generic card that had a cost of goods sold, a purchase price of $1 each. And you would crush your soul trying to do that. And so that's not the way I would suggest doing it. When I do mass box openings for final trade and I buy anywhere from, 20 to maybe 60 or 80 boxes at a time to open, I don't take 80 boxes times 500 cards per box is 40,000 cards. I don't try to record it as 40,000 cards that I paid 9 cents each for or whatever I would pay. What I do on a mass box opening is I expense 100% of that box's cost immediately. And I have a rationale for that, and this is where we get into kind of the philosophy of business accounting, which is you can do a lot of things that are not correct if you have a strong rationale for it. And you always have to imagine yourself sitting in an audit with a government agent across the table pointing a gun at you, and you have to explain why he shouldn't shoot you. And so if your rationale is good, you're more likely to be okay. And so my rationale is, well, when I do a mass box opening, 90% of the value of the cards, not the total number of cards, but the value of the cards, is going to sell within the first month. It sells very fast. So if I expense 100% of the cost of those boxes on the day that I get them, my accounting is not out of whack from reality for very long by a very large amount. Obviously, at the moment I expense it, I've expensed 100% and I've sold 0%. So my accounting is way out of whack at that moment. But over the course of the first month, as 90% of the value sells, my accounting is almost approached reality at that point. And then in the second month, probably another, say, 5% of the value sells, and the final 5% will sell over the next 6 months, or it'll melt to zero. And so very quickly, what I've accounted approaches reality. And I've had other patrons I've talked to about this exact same subject. And I had one that once told me that his accountant recommended that he do something like take 70% of the value of the boxes as an expense immediately and 30% in the next calendar year. Yeah, you could do that. That's fine. You would just carry the inventory value over into the next year. That 30%, you would carry that across through the fiscal year into the next one, and then you would write down the rest of it in the second year. You could do that. Or you could do, you could step it down in quarters. You could take 40% the first quarter and 30% the next and 20% in the third quarter and 10% in the final quarter. You could do that. You just need a rationale. And, there are a lot of businesses that will engage in the same activity and they will account them totally differently because of the realities of their business. And as long as they have a rationale in it, two examples that I like. One is car companies allocate R&D costs to every unit they produce. And so when Ford is out there today, they're going to spend, say, just make up numbers. They're going to spend $1 billion on R&D this year, and they're going to sell, let's say they're going to sell 10 million cars. Well, that's $100 per car of R&D. And so they allocate that R&D, even though the R&D they're doing today is for cars coming in the future, and the cars they're producing today were built on R&D done in the past, they're still going to allocate today's R&D to today's car at $100 per unit. Okay? Now, if you're in the aviation industry, often you're going to do R&D millions of dollars worth for decades that never comes to market. You're going to explore things that end up being utter dead ends. And so you take R&D as just a total business expense below when you've calculated sales, and in that part of the accounting where you're talking about operating costs and SG&A and other things, you'll do R&D there, even though both businesses make transportation vehicles and they're both doing R&D. Okay. The other example I like is, let's say you've got a business that brings in metal shelving, they import it from China and they sell it on Amazon. Okay, so they're an importer selling on Amazon. Now, you have two businesses that are potentially customers of them. One is Final Trade, because Final Trade needs more metal shelving to hold inventory on. So I'm going to buy that, and I'm going to pay sales tax on it because I am the final end user of that metal shelving. And most of the time, I'm going to write that down as supplies. There's an argument for making it a capital asset and depreciating it over a number of years. You can make that rationale if you want. I just go ahead and write it down as basically office expenses and take the entire cost as a write-off in the year that I bought it. You might have a second business, though, that is a office furniture company, and they need metal shelves to have in their storeroom to sell to customers. They will not pay sales tax on them because they are not the final user of those metal shelves, and they add them as inventory. And so they will write down the cost of goods sold when they sell the shelves because they're doing accrual accounting. And so you can see that both of those businesses buy the same product from the same seller on Amazon, and they account them completely differently because the realities of different businesses are legitimately different. And so with this patron talking about buying collections, I told him I would do much the same thing with a collection that I already do with mass box openings. I would just say that, hey, based on my experience, and, I would invite him to apply whatever his experience is in the way he sells collections. If his experience is that 70% of it sells in the first month and 25% sells in the second month, then I would say, yeah, just go ahead and write down 100% of it the day you get it. Don't worry about it because in 2 months your accounting will be approaching reality, and that's not a big deal to be out of whack. The only time it even comes into question is when that 2-month period bridges through the end of one fiscal year into the beginning of the next. And even then, accrual accounting always approaches reality on a long timeline, even if you're really bad at keeping track of your inventory. Accrual accounting, you'll be wrong in the positive direction some and wrong in the negative direction other times, and it does balance out over the long timeline. So that's how I would handle that. I would never try to say, oh, well, this collection, it had some boxes and I'm going to put these at this value, and it had some graded cards, and then it had a lot of singles, and it had some promotional items, and it had some Snorlax plushies and all these other things. I would not try to break it up like that. Now, there is one final thing to talk about on this subject, and that is when you run a YouTube channel. There's something interesting that happens. Things you use to make videos on YouTube are supplies in your business, and you can write them off immediately. When I make a video about Conan comics, those Conan comics are supplies that I use in the business for making videos, and they could be a business write-off. When I do a video of me building a Lego set or, mocking a Lego set that I've already bought and altering it, that makes those supplies, those Lego sets and the extra pieces I order, supplies that are used for making videos for the business. And so the IRS does not care what happens to those supplies after you use them. You have written them down as a cost for your business, and then the IRS does not say there's some, you have to shred it or burn it and mail them to ashes, though if you do, let me know. But, there's no specific thing you have to do to dispose of those. And so one thing Rudy does, and he's mentioned this before kind of in a coy way about, he said something once like, you accountants will understand what this means. But essentially when Rudy buys collections, when he buys $50,000 or $100,000 collections of vintage magic, he's buying those as supplies to make videos. That's why he publishes videos showing his collection buys, is then he can write that down as supplies to make videos and write off the cost against profits in his business. And it makes sense because he's not buying those cards as inventory. He has no intention of ever selling those cards. So they legitimately are not inventory. And so they are supplies for videos. And that's why he makes the videos and publishes them, is so he can have that rationale that those are essentially a supply business expense that is written down against profits. And so that's why I've talked to some patrons in the past. Like if you're just a fiend who wants to open a bunch of Magic boxes because you love Magic, make yourself a Magic YouTube channel. And those Magic boxes are supplies for making your videos. And you could write them down without having to then sell the cards, sell the excess that you want, and make money back that way and treat it as inventory. Now, the one caveat to that is if you do then eventually go and sell those supplies, since you've written them down originally as supplies, they now have a basis cost of 0 and you have to pay tax on the entire revenue earned from those because essentially you've written down the cost already in the past, so you can't write it down again. So there is that, but that's one interesting consideration when you run a YouTube channel is that the things you use in videos are potentially supplies that can just be written down right then. But then if you eventually reinsert them to inventory and sell them, you have no basis left and you have 0 cost of goods sold for that thing because you already wrote it down. Hopefully most of that was clear enough. Don't drive yourself nuts trying to account individual cards. Potentially, if you're a dealer who only deals in, say, graded vintage Pokemon, maybe you keep an inventory of individual cards. And, you probably have some ability to record the serial number of the slab for each of those. And then you could allocate even just notionally what you paid for each one. And that way, when you then sell them later, you have a cost of goods sold that you can reference. But outside of that, I would just do what I do and write down the entire cost of all the boxes for a mass box opening or a collection you buy with the intent to resale. I'd write it all down right away and then sell off the parts over time in a reasonable period of time. If you think it's going to take you 5 years to sell the collection, then you probably don't want to write it down that way. But if you think it's within a couple of months, then you have a good rationale for doing that. Let me know what you think. Thanks to everyone who makes this content possible, especially my very generous supporters on Patreon who get all these kind of tax and accounting and business questions answered and sometimes even videos made. Like, comment, share, and subscribe and join me on Final Trade.